Yeso Panch Namakaro Sabapa Panasano Manglanam Savesing Padamam Hawaii Mangalam Padamam Hawaii Mangalam. Lot of Mangalam from everyone. And next I'll invite our chairman, who is on a holiday at the moment, Mr. Kiran Bhai Mehta. Yeah, to introduce the speaker, please, sir.
Jai Jinendra, everyone, and welcome to our first digital meet for GTO UK. Hope everyone's well. I want to introduce AshokBhai. I'm not sure whether I need to introduce AshokBhai because most people here will know. AshokBhai is an investment director for London and Capital. He's been in this industry for a while. I've done 45 years in finance industry, and he can still baffle me. His knowledge is immense. He spoke at international level, hosted CNBC, Bloomberg, etc., and also been a regular speaker at GTO events. So immensely grateful to Ashok for coming on board for the first one of these forums. And without further ado, just got a few more joined who need to be muted. So, so without further ado, I'll pass it on to AshokBhai. Over to you, please. Thank you.
Jai Jinendra, everybody, and good evening. Welcome to this presentation. The format of the presentation really is that I want to talk about, the state of the world economy, where we were, where we are right here and now, and where we are going to be going, and the events that have been affecting what has been happening out there, both in terms of the economic development and, of course, the financial and the market development. And as mentioned earlier, if you have questions, if you start posting them, and then we'll try and see if we can deal with as many as we can. So without much further ado, I want to start by simply giving a rundown very quickly on, in terms of, what happened in the last financial crisis in 2008 and 9, and then the trajectory thereafter. So we got into the crisis in 2008 and 9 because the system got incredibly leveraged. So the banks were leveraging their balance sheet quite dramatically. And effectively, just needed something to go wrong, and then you get a negative feedback loop, and that's exactly what happened. And in order to get out of the crisis, effectively, we added even more debt. So we never deleveraged in the last economic cycle. So this cycle, we have continued to add ever increasing more amounts of debt. And effectively, there are breakdowns in the presentation in one of the slides in detail. And
Ashok, can I interrupt you for just, there are few people are saying the volume is not good enough. If you can push your laptop near to you, I think it might do the trick.
Yeah. Is it better now?
Yeah, I can feel it's better, definitely.
Okay. So basically, so in this cycle, what has really happened is that we have continued to increase the leverage even further to very high levels. And one of the consequences of that is that the ability to raise interest rate was quite restrained. So, you think about Europe was already in the world of negative interest rates, and Japan was in the world of zero rates before we got into this crisis. So we were very handicapped in terms of having margin to reduce interest rates. And I'm going to leave it as simple as that. And what effectively happened was that this cycle, the economic cycle, which is just ending now, was actually one of the longest cycles that we have seen. And since the start of, since the United States came into existence, this was the longest cycle, the first decade without a recession. And remember, when the cycle gets very extended, a lot of excesses get committed. People get carried away. The way the brain is constructed, it basically says that if it was good yesterday, it's going to be good tomorrow. So if I took risk yesterday and paid off, then I'll double my risk for tomorrow. And that's roughly how we ran the cycle. And what the central bankers wanted to do really was to make sure that this cycle was as elongated as was possible. And they did by all means available to them And of course, one of the consequences of that is that when a cycle gets extended, eventually when it does end, it's much more harder in terms of the depth of recession that you will see. But of course, you never know what ends the cycle, and it's always an unknown unknown. So in terms of what happened this time round was that, we had coronavirus that hit us really, really hard. And so what really the consequence of that really was that the authorities, in terms of the government, had to respond to control the virus by engineering stay-at-home and social distancing and so on. And those, in terms of closing the economy, about half of the world economy got closed down. So that's really dramatic. We have never had this kind of situation in the history before. And so herein lies the thing that coronavirus effectively has initiated what I would say is 5 massive crises. So they are all simultaneous, as big as 5 which we have never had before in our history. So what we got initially was a supply shock. Because the world is incredibly integrated, it means that the products that people consume, have inputs from a whole range of countries. And as countries begin to close down, the supply chains get disrupted. So the first is really the fact that the supply chains are now pretty heavily under pressure.
Ashok Bhai, interrupt you again. Sorry. The infographic looks very nice. Can we do the complete screen share the way we tried yesterday?
Yeah.
Oh, perfect. That looks nice. Thank you.
So the next real crisis with us is really the demand destruction. Staying at home and isolating ourselves means that the demand has been taken away from most of the economies. And that basically means that, we are not consuming things that we used to consume. So think of the sectors that are closed down, like airlines, restaurants, and so on and on, schools, and it's a very, very long list. So as I said earlier, close to half the global economy has been shut down effectively. So that's massive, effectively destruction of demand. The third crisis that we are facing here and now is what I would call a credit crisis. So if a lot of industries effectively shut down, it means that the cash flow going around the system abates. It's not going around anymore. That means that those who are very leveraged, who need regular cash flows in order to make the coupon payment, are being denied that facility. So that means that we have a massive default and a credit downgrade cycle evolving in front of us. Then the fourth massive shock that we have, the system is absorbing, is an absolute collapse of the oil price. So this effectively, even though good in terms of the petrol prices going down, but really the point is that a lot of the oil producers, energy producers, if you look at shale oil in the US, they are incredibly leveraged companies out there. And at this kind of oil prices, virtually all of them are bankrupt. They broadly need about $35 to break even. And on a just current cost basis, anything below $20 a barrel, and they're all pretty much bankrupt. So you're looking at large-scale bankruptcies in those sectors where cash flow has been denied. So effectively, all companies are going to get downgraded. Large percentage of them, those that don't benefit directly from the crisis, are seeing erosion of their revenues in some form. And that is a critical ingredient into the credit rating of the corporate world. So we have this massive downgrade cycle that will probably go on for a whole year in front of us. And then, of course, the last crisis that the world is dealing with is really one of wealth destruction. In the amount of wealth that has been destroyed by the markdown in market prices for everything from property to equities to bonds. That basically means that the consumer habit, consumption habits, are going to be much more conservative, and people are going to worry a lot more about being spend free in the future. So just to sum it up, so we got 5 crises which are running through here and now. And the impact of that is huge. This slide here is just an IMF rundown, which is telling you that the recession we are going to have is going to be even deeper than the one we had in 2008 and 9. And of course, most of the estimates that come out of world agencies they tend to be a bit more on the optimistic side simply because they don't want to create a negative feedback loop themselves. So for example, the first quarter GDP numbers are just coming through, and the US number came at minus 4.8% annualized for the first quarter. The estimates that are in the marketplace for the second quarter are anything between minus 30 and minus 40%. I'll repeat that. The estimates for the second quarter GDP, the US is going to be like minus 30 to minus 40% on an annualized basis. And similar numbers will come from most of the developed countries. So you are looking at the pretty dramatic meltdown in the economic growth. And one of the biggest consequences of the downturn in the economic cycle is the massive rise in terms of unemployment, because a lot of people are getting furloughed, but effectively they'll be made unemployed in a few months' time when that support either dwindles away or is not renewed or renewed in a smaller format. So you are looking at a pretty cataclysmic situation which is still evolving. The depth of it is not yet fully on the table, and it's not fully understood either. So that's very important, that we get this background in ourselves. So if I'm saying that things are looking pretty awful and they have not been as bad as this as 1929 when the last depression hit us, and it's probably going to be as bad but much more compressed, much faster than the depression evolved itself into mini cycles, but very bad. This thing is all happening like a fast motion picture. So how are the authorities responding to this? And what I want to do is go through in terms of what the governments are doing. So the governments around the world can actually see the meltdown taking in place in front of them. And remember, the meltdown is totally voluntary. Why voluntary? Because a political decision was made to stay at home and then effect social distancing. So effectively, the governments are the ones who actually stop the companies from functioning, stop the people from going to work. And so they become totally responsible for ensuring that the recession that we are in now does not cascade and become a depression. And so what they have done effectively is to open the fiscal taps completely as whatever is needed to safeguard the global economy so that the recession is moderated and then engineer an eventual recovery. So if you look at the type of the budget deficit spending that is going to be taking up, and this slide is showing you the discretionary spending. So it's not looking at other stuff like funding of the existing debt that the government carries, but this is huge amount of government aid being given to the global economy, individual economies. It's unheard of amounts. Only time that the governments engage in this kind of spending if there is a world war going on and people are being bombed and dying and the industries are getting knocked out. That's the only time governments would do something like this, which in normal conditions would be considered totally irresponsible. Now, this amount of the help that the governments have put in is actually going to continue to increase for the next 1 and 2 quarters, because many of the programs will be rolled over and increase in size. So you're talking about pretty large scale helps yet to come. So just to understand, what does it actually mean so that we can get our minds around it? And if you look at what US is going through right now, so for 2020 calendar year, the budget deficit in US is already running at around 20% of the GDP, because that 450 billion package was actually approved at 483 billion, was signed off by Trump last week or beginning of this week. And then there is another big package of about 700 billion that is under discussion on the table, initiated by the Democrats. So we are talking about the budget deficit just for 1 year in the US, probably going to 25%. These are completely unheard of numbers in any of our living memory. And it's going to match what happened in the depression years of 1929 and onwards. So clearly, huge amount of help is being put on the table to make sure, first, that the people do not starve. So we are in the world of helicopter money, where families are being given money directly, bypassing everything, so that they have enough money to buy food and so on, and basic minimum living expenses. This is another version of soup kitchen, but we can't see it. I mean, the only place you can actually see soup kitchens today, actually, perversely, is in India. If you, I know many of you guys would be aware of these 150 million workers who are trying to go home and can't go home. And so they are basically queuing for soup kitchen. It's that version. So this is really very, very serious. So the governments are spending whatever it takes to ensure that the population does not starve, and that the companies that are viable today can be helped to come out on the other side and survive. We can't let all SMEs go bankrupt, because it takes a long time to create that. Some will go bankrupt because their balance sheet construction is no good, or their products are no longer needed and they have no reason to exist. But a lot actually are good companies and they just need a helping hand. And so this is what the system is trying to do. And this is not just the US, the whole world is doing it. So that's what the governments are doing. Now, what are the central bankers doing? So the first move that the central bankers made really effectively in the developed world was to cut the interest rates to zero. So anybody who had room to cut interest rates has been cutting them. Many countries don't have room to cut interest rates. Like if you are in Europe, you're already negative interest rates. You can't really increase that further down negative. Japan is already zero interest rates, so unable to really go much further down. We are at, in UK, 0.25%. US is already at 0.25%, 0 to 0.25%. So we have taken the interest rates down as much as we can. Most of the other developed economies have done the same. Many of the emerging economies have been cutting interest rates, and probably more cuts will follow from them. However, the cut in interest rates in aggregate are really insufficient amount of help, okay? So what the central bankers have said, that if we run out of the room to cut interest rates further, what can we do? And effectively what they are doing is to go into unlimited quantitative easing. So that means that they are going to print whatever amount of new money that is needed to keep the system afloat. And this chart tells you for 2020, now, here and now, how much extra liquidity has been put into the global system. You're looking at as a percent of GDP. So these are massive, massive numbers, yeah? These are huge numbers. So the world is swimming in tide of money right now. And the reason for this is multifold, okay? So effectively, what the Federal Reserve Bank has done is that when we were at the height of panic about a month and a half ago, many of the markets became dysfunctional. In other words, there were no counterparties. If you wanted to sell, there were no buyers. So the market prices just died for everything. And you cannot function a system without a proper trading going on. And so the Federal Reserve Bank had no choice, and nor did the other central bankers, but to become buyer of the last resort. And so what the Federal Reserve Bank has done is it started by being buyer of the last resort initially for the commercial paper market. This is the overnight repo market. This is the market where large companies can borrow money very short term in order to pay wages and day-to-day expenses and carry on. And that market became illiquid, and the cost of borrowing started to rise quite dramatically. So the Federal Reserve Bank stepped in initially with only 30 billion, and it went up and up. These are daily amounts to 70 billion. And then it effectively said, we will supply whatever is needed in overnight market. So it basically made sure the overnight market was functioning and calm and was not pricing any catastrophic pricing risk. Then the second market it stepped into, which is very important to the world, was that the dollar started to go exponential. So there was a shortage of dollar around the world. And why was there a shortage of dollars around the world? It's very simple. The world ex-US has effectively borrowed around $1.8 trillion worth of debt. And a lot of this is borrowed very validly. So if you are an international company, you borrow in dollars, you put plant and equipment, you know whatever you're going to produce, you can sell it to the world in dollar prices. So even though you're a dollar debt, you got forward dollar revenues. But if the world trade starts contracting as it is now, and if half of the world economy slows down, then you don't have the cash flow to service those debts. So all of a sudden you have an asset liability mismatch on your balance sheet. So there was a scramble to reduce that mismatch. And so the dollar went exponential. And obviously that is in nobody's interest, because it then means that your liabilities as the dollar goes up, and if you are unhedged and your borrowings in dollar, your liability side is going up much faster than your asset side. And that basically means that, your strength of the company is getting eroded rapidly. That means you get a credit downgrade cycle. It means that the borrowing gets harder when you have to roll over the capital. So it creates a negative feedback loop. So what the Federal Reserve Bank did was effectively supply very, very large amounts of what is called international dollar swap lines to quite a lot of central banks around the world, but it did not include Bank of China. And those lines have subsequently been increased, and more countries have been added to the list. And that allowed the dollar to calm down and correct a little bit. And then it walked in and basically is effectively become the buyer of last resort for the US Treasuries, US muni bonds, US commercial asset-backed paper, residential asset-backed paper. It's become the buyer of last resort for all of the investment grade in the primary and the secondary market. It has become buyer of the last resort in the collateralized loan paper. It's become buyer of the last resort in the high yield. This is the risky part, the one tier above the equity on the balance sheet. It's become buyer of last resort there. So it's effectively backstop a large number of the risk market to bring stability and calm first to the financial market. And by doing that, it brings financial stability to the whole system. And something very similar is happening in Japan and in Europe and in UK and some of the other countries like Australia, New Zealand, and Canada. So the central bankers now have become buyers of the last resort, and they are underwriting all the risk markets. The only central bankers that are openly buying equities are just Bank of Japan and Swiss National Bank. The others are not yet stepping into the equity market. And question is, at what point are they going to be forced to come and backstop the equity market? Obviously, the huge rallies we have seen in the last month eases the pressure to backstop the equity market. But those pressures will reinforce themselves. And the way they reinforce themselves is that each of the countries have too large to fail critical companies, whether it's Boeing or General Motors or whatever, because of the long chain of suppliers. So it's not just the direct employees employed by Boeing that is important, it's all the other suppliers. And it's 10 times as many outside the system in terms of outside of Boeing who depend on Boeing itself. So this becomes critical companies. And obviously we will have critical sectors like airline sectors and trains and buses and all of them. And it is quite likely that different countries will find different ways to bail them out to ensure that because the economy needs these sectors, that sectors do survive in some format. So there will be a mixture of free capital, 0% interest loans, some kind of equity injections, and everything is going to be happening. And that's how the backstop to the equity market will come. I don't think that the main developed country central banks will follow the example of Bank of Japan and the Swiss National Bank of physically going in and supporting the equity market directly by buying, a standardized ETF. But they'll support it in other ways, and it's almost tantamount to backstopping the riskiest part of the equity market, which is really where the help is needed. What I want to do really is just kind of talk about in terms of how first the economy is going to evolve and how the markets are going to evolve in the next 12, 24, 36 months. So the first thing to note really, and to an extent, it's not yet probably fully recognized in the marketplace, is that the first quarter earning results are just coming out on the table this week and probably next week and so on. And they are, for a lot of companies, they're pretty awful numbers. But the second quarter numbers now, this quarter that we are living through, those numbers will come out in first, second week of July, and they are gonna be pretty awful. So we are looking at probably corporate earnings in aggregate for S&P 500 for that quarter, probably going down by around 30–35%. So that's the decline in the corporate earnings. Just to get our minds around, when we started the year, the market consensus earnings estimate for S&P 500 was around 9 to 10%. And right now, the market consensus earnings on the bottom up basis is around -17. But the top down consensus earning estimate is around -35% for the whole of the calendar year. Yeah. So by market going sideways, i.e. not falling, it's becoming a third more expensive than where we started. So the markets are getting incredibly expensive, and we've had a rally. And the rally is really all due to the liquidity that has been injected into the system right now, and it's going into the financial assets. And obviously all financial assets are beneficiaries of that now. And those that have not recovered, probably a bit more recovery still in there, even though the underlying fundamentals might be awful. But you know, the standard proverb is that you cannot bet against the central bank. You will always lose. And the market in the US has been trained to think like that, which is why the rallies in the US have been the strongest compared to the rest of the world. And also the US economy is much more balanced, well diversified, and it's a lot less dependent on the world compared to the other equity markets around the world. And because of the stability of the US economic system, it means that they fall always less and they always recover much faster than other equity markets do. So one should never forget that, yeah? Most other equity markets have a lot more cyclicality built into it. The other thing that drives the US equity market is that when you look at the top 5 companies, you know, they're basically beneficiaries of the current environment, whether it is Google or, you know, Amazon or whatever, Microsoft, you know, they are ideally suitable for a world of internet communications and stuff like that, yeah? So they have been big beneficiaries and they're pretty much recovered. Their earnings are gonna be pretty good. So yes, there'll be volatility in their earnings, but that again explains why the US market behaves so much better, because all the leading companies, large percentage of the world's leading companies are based in US and come out of US. So what I want to discuss now is really the impact of the high level of unemployment that we are going to see. Remember, close to 30 million people have lost their jobs in the US already, and it's probably going to rise even further by another maybe 10, maybe 15 million more. So you're talking about a very, very high number of unemployed people in the US.
AshokBhai, before we move on to unemployment side of things, there's a question related to the market value. Shall we take a question now?
Yeah, we can take it now. We could come later, but it's fine. I was just going
to... Let's do that. Let's do that. Let's proceed, and then we'll come back to that question.
Yeah. Okay. So because I was talking about the equity market, I just wanted to come on to the fixed income market, and then we'll take the other question. There's some more stuff I'll come later. So the way I want to explain was that the huge increase in the unemployment has a very simple impact, which a lot of people don't seem to fathom, which is if you lose a job, you can't make your car payment, you can't make your mortgage payments, you can't make your student loan payments, you can't make your credit card payments because you have no cash flow coming in and you're already negative equity, you know, you're indebted. So basically the delinquencies or default rates in all kinds of things is going to rise quite dramatically. And that again is telling you that there is a credit downgrade cycle for those companies that are involved in supporting the consumption through financing and so on. And obviously, the banks will take some hit because that's what their core business. But the non-bank financial institutions are the ones that in this cycle have really done most of the lending, because the banking sector has been under increasingly tighter regulations and not been able to expand their balance sheet because they had to increase their core tier 1 and tier 2 capital. So they basically, in this economic cycle, have still been repairing their balance sheets so that they don't become too big to fail. In other words, next in this crisis, the taxpayers will not have to make the banks bail out. And the banks have already been told to not pay any bonuses, stop buybacks, and stop some of the dividend payments as well to conserve capital. But the non-bank financial institutions are at the cutting edge, and that's where the damage is going to occur. But of course, it will cascade into everything else, because if you damage the lenders of credit, then they are going to take 5-10 years to repair themselves. So in the next economic cycle, they will not be able to lend. So we will have difficulty in terms of credit channels working properly for everything. And therein lies the other problem, which is that everybody says that if you print this huge amount of money, will you not create inflation? But the problem is that in a recession, in a depression, it's deflationary, not inflationary. And you only get inflation when the high-powered money that the central bank prints gets converted into low-powered, M3, which goes out to the world, and then it creates demand, and then it takes out the excess capacity output gap, and then it creates inflationary pressure. So the inflationary pressures are going to be many years before they come into the system. So I'm going to leave it at that, and let's take some questions, and then maybe I'll come back to some other points I want to cover later.
Okay. Thanks, AshokBhai. The first question we have is Kiranbhai. Kiranbhai, do you want to go ahead with your question, rather? Kiranbhai?
Okay. Thank you, AshokBhai. As ever, obviously, huge amount of knowledge grasping here for all of us. But just a quick question. There are many negative factors here. Then, but the share market went down, FTSE went down to 5,000, and then it went up to over 6,000. So why would that be? And where do you see the FTSE?
Okay, so that's a good question, because it applies to all equity markets around the world. FTSE is not the only one. So, I mean, it's just equities went up. And the reason is very simple. You know, if you first cut the cost of capital to zero, and then you provide unlimited amount of liquidity, then that really is what is driving. It's a liquidity driven market. It is not a fundamental driven market. It is tied of the liquidity where good and bad and ugly, everything gets lifted for now. And that tide of liquidity is not stopping. The money printing is going to go on probably all of this year and probably more than half of next year, if not all of next year. The money printing will go on until the economies are seen to be recovering properly and employment gets created and so on. So whilst you have this tide of liquidity, it's holding the asset markets up. And the point I was making is that the markets, by being held up, are getting more expensive because earnings are going down. So your PER, price earnings ratios, are going up. Market is fundamentally becoming expensive every day that goes by, even though it's going sideways. Yeah. I don't know if that helps you.
Yes, thank you. So do you see the market then carrying on going up, or do you see some bumps?
So the way I would put it is that the market is pricing, if it was pricing, an awful lot of good news, and is ignoring the very, very bad short-term news that will come out in the next 3 months, you know, in the next quarterly reporting. Remember, this month is the first quarter's reporting season. The second quarter reporting season doesn't come until July. And that's where the biggest hit to the earnings is going to get reported. That's when companies are going to simply say that we didn't have money to pay wages and stuff like that. And that's when, you know, all kinds of things will happen, filing for bankruptcy or asking the government for help. So I think in a way, a lot of good news is priced in, and effectively the bad news is being ignored because the way the market is thinking is that, oh, we are going to recover. Come on the other side, we can look to the bad period that we are in right now. We don't need to get too worried about it. And of course, what happens is the amount of bad news that will come out will truly shock us all in 3 months' time.
Thank you.
So true. So, AshokBhai, I have another question. I've got 2 questions before I let you proceed again on your presentation. First one is from Amit. Amit, do you want to go for it?
Hi, thank you, Uncle, for the good talk. I was wondering, so the question was, sorry, I wrote it down 1 second.
Aggregation of the expenses.
Oh yeah. So if you increase income tax, for the government to get more money to increase government spending, so they'll have a bigger budget. So if you increase income tax, won't that lower the disposable income of people, and they'll reduce spending, and that'll just reduce aggregate demand?
What a wonderful question.
This is from my son, Samyak, not me.
It's a wonderful question because it's a 101 economics, yeah? The problem is that the rules of economics are being held in a band. Let me explain to you why.
No, he's some expert giving his opinion on our Naunal side. He's
So,
an investment banker.
okay, so the way I would put it is
No,
like,
he's Zoom meeting. He's giving advice on.
Sorry, Deepak. Okay, thank you.
so it's a very good question, and it's a question a lot of people ask. And the way I would answer it like this is that what the central bankers have done is to ensure that the cost of carrying the government debt is minimal. So in other words, they have given the license to the central government to spend whatever money is necessary in order to get over this crisis without worrying about the cost, the coupon cost of the cost of debt. So if you go into zero interest rates and you go into unlimited quantitative easing, so unlimited quantitative easing, when you sit down and really think about it, is really in plain language, is called yield curve control, which basically means that the 10-year cost of money for the government will be taken down to zero interest rates, okay? Just like in Japan and negative in Europe. So that means that government can issue whatever debt to whatever deficit it wants, it can issue debt. And since the central bank is buyer of the last resort, it will buy all the debt at 0% interest rates. And so it's not the mercy of the market to buy it. So in terms of therefore funding the budget deficit and the accumulated debt and the coupons on it, basically it's going to be minimal. And so there is no danger that it needs to raise revenue here and now. The way, what will happen is that the government debt to GDP will rise quite dramatically in the next 24 months. And it's a repeat. The only way that the governments will unwind the debt is what happened in the last 2 world wars. It takes 2 to 3 decades to unwind the government debt. And by holding interest rates low, it's under no panic to have to raise interest rates. But for political reasons, there may be wealth tax and so on, extra property taxes and so on. But that's much more politically driven to balance out the inequality in each of the societies. So if you think about what happened in the last 10 years, who were the biggest beneficiaries of the quantitative easing? It was the owners of the wealth. So you got large percentage of the population, 50, 60% of the population, who don't have any wealth. So they did not really technically benefit because they didn't own asset markets, including real estate, which is what went up. So the quantitative easing increased the inequality in the system. The rich got richer, poor got poorer. And what we are doing is more quantitative easing yet again. So it will exacerbate whatever happened in the last cycle. And so, maybe the politics will change and there will be wealth taxation, but that's different. It's politically driven. It's not to fund the budget deficit. I don't know if that helps you understand.
Yeah, thank you, Uncle. Help me understand. But can't the rich avoid taxes by using corporations? Because I read it in a book called Rich Dad Poor Dad by Robert Kiyosaki, and he talked about how corporations can help the rich people consume first, and then with the remaining income spent, like use it on taxes and expenses?
Yeah, but unfortunately, rich people don't behave like that. They just keep accumulating wealth. So all these textbooks don't work. Yeah.
Yeah. I got
Okay,
quite a
thank
few questions now.
thank you. Please go ahead here.
Thank you, Amit. Mahesh Chodia, can you please go ahead with your question?
Thanks, Girish. Thanks, AshokBhai. That was really interesting. I think it's a continuation a little bit of what you just talked about in terms of QE and central bank expansion of their balance sheets. At some point, there has to be an impact in terms of other asset classes. And in this case, I guess I'm thinking gold as a first stop, but on a wider context, it's more real assets. So again, real estate, and if I may dare, Bitcoin. So in terms of just the dynamics as this crisis evolves and as central banks keep responding to this, there's going to be a point where people feel it's come to a point of unsustainability. So how do you see this playing over the next 6, 12, 18, 24 months?
Okay. Yeah, I have a beautiful question. Beautiful. Well done.
Thank you.
The way I would put it is the following. Basically, quantitative easing is an attempt at competitive devaluation. Because everybody is doing it, nobody can devalue. So when you look at the currency cross rates, they do not give you the real thing that is happening, that the system is getting flooded with money. Because it is a relative price, it is not an absolute price. Gold is an absolute price, it is not a relative price. And so ultimately, the goal will tell you the real attempt at devaluing your currency. So in a way, it becomes a real asset which will hold value ultimately. But the real value of gold will not be proven until we have hyperinflation. And I explained earlier that we are currently in a deflationary environment rather than inflationary environment. You get inflation when the demand exceeds supply, so the supplier has the pricing power and he can raise prices. Labor is not going to have any pricing power, probably for next 5 years, given the level of unemployment we are going to be seeing. There's going to be surplus labor all over the world for a very long time to come. And in terms of productive capacity and all that, look at energy. We're going to have to shut down the oil wells because we don't need the damn thing right now. And something similar will be happening to many. The capacity utilization rates have probably dropped about 10 percentage points. And that's going to take a long time to put the idle machines that we already have into use and so forth. So until we use up the spare capacity, which will be another 3, 5, 7 years. So we don't have an inflation issue for a while to come. So in terms of other real estate assets, again, it gets very complicated. So if we go into the world of property, and then it's not unified, it's very homogeneous. So, office properties versus residential properties, retail versus warehouses, emerging, developing, etc. It's a very complex equation. And the world we are in, a large percentage of those assets are going to get punished. Okay, they're not beneficiaries. If economic activity goes down dramatically, people can't pay rent. They don't have their ability to pay rent. I know real estates are real assets, but they can be worth a lot less. It's all driven by the earnings power of underlying assets eventually. It is a store of value, but in the very long term. And they only come effective if there is hyperinflation in the system. And then, in terms of the real assets like commodities, other than precious metals, rest really are going to be very painful to own for a pretty long time to come. I hope that gives you some idea.
Yeah, absolutely. Thank you so much.
But I would say that, owning gold, obviously in a world of zero interest rates, normally gold does not earn any income. So that handicap is no longer, there to worry about, because in a world of zero interest rates, you might as well own gold. But again, the point is that it's a very different life cycle to other assets. Yeah, and you can use it as a diversifier, but it is a very long-term call. It is not a short-term call in owning gold. And every time there's a flight to safety, dollar benefits first, and then gold may or may not benefit, yen benefits, and so on, Swiss franc benefits.
Yeah. Excellent. Thank you.
Thank you. Just two more questions before I let you go on. I've got a lot of question list, but I'll limit it to two for now. Shrenik, you have a question?
Yeah, hi. Can you hear me?
Yeah, I can hear you.
Yes,
Yeah,
we
hi.
can.
Hi. Thank you, AshokBhai. I think your presentation and I think your knowledge is immense, and the experience is always what we amateur investors look for. Like I've been actively looking at the stock market and reading plenty of available free news, because nowadays it's something that's available very freely. On the point of liquidity, you mentioned, regarding the federal government or the central bankers being the last resort and they will buy absolutely everything. But from what I've been reading, the stock market been rallying. I just want to confirm that is the equity market also being bought by these central bankers? Because usually I think this is one place that they do not enter. In like, it's a last resort. But so far I've read everywhere that they're buying the tertiary market of the MBSs and CMBSs and mortgage-backed securities, but they still are yet to enter the equity market directly, like a direct intervention to stop it from falling. How does the other markets which they are buying in impacts the equity market? Because this is something I've never understood. Because apart from the financial crisis where you saw that banks were actually being bought by the banks, or you take a percentage like RBS and Lloyds and all these banks, but we have not seen the similar scenario at the moment. Is that because we are waiting for the next fall to come along, because that's what happens when the dead cat bounces? Or
Okay, so
your insight?
there's a number of questions you're asking. The first point you are asking is, and I explained that Bank of Japan and the Swiss National Bank, they are the two who have been buying equities quite a lot. The other central bankers have resisted buying equities. In case of China, it's got some of the official arms, some of the big funds, pension funds, which are run at the government mandate to go in and support the market and so on. So it's technically government is buying large amounts of the Chinese equities. In the last crisis, about a year and a half ago, when the Chinese equities disconnected and wanted to fall 50, 60%, and it just went illiquid, 10% down every day. So it allowed those funds to enter the marketplace to stabilize and bring it into a steady state. And it's been one of the better performing markets since the beginning of the year. Now, in terms of the other mature markets, the central bankers buying the equities, that step has not yet been taken. But if you buy high yield paper, which is what they are doing both in US and in Europe, then it means that you are already, in terms of the balance sheet construction, just one layer away from buying equities, okay? And the way I was explaining was that we may not necessarily see direct buying of the equity ETF. The way we will see the equity markets getting supported is support coming into the highest risk, most vital parts of the economy. So like I was explaining, Boeings of this world or General Motors, or critical sectors like airline or whatever. And the way that the US is going to do is, because it wants to not necessarily want the government to step into the equity side of the equation, it will find other ways to support these companies by ensuring that the markets remain open for them to increase their leverage and funding, and if necessary, they might get given long-term contracts by some of the defense, part of the budget and so on. So there are many, many ways that the support will be rolled out to the equity market. But the biggest support that you can roll out to the equity market is to ensure, since most companies have a lot of debt, is to ensure that the debt markets are willing and open to give new debt and to roll over the maturing debt. So the equity guys can breathe a sigh of relief that the companies are not going completely insolvent, and that the debt gets converted into equity completely and they get diluted out of existence. So the equity market that gets support from, first of all, central bankers ensuring that the risk markets are tradable. And in order to make tradable, there should be a buyer for every seller. And if there are no buyers, the government agencies, including the central bank, can step in, or pension funds that it controls can come in and become counterparties. So that's how you support the equity market. And then ensuring that there is no shortage of liquidity in the system by supplying whatever liquidity is needed, then you reduce the forced selling. Now, if you think about why did the equity market go into a meltdown, think of the mechanics, think of the steps that took place. So what happens is that when you have a very long economic cycle, it tends to create a long bull market. And as the bull market gets longer and longer and longer, you get more and more leveraged players getting drawn in and running incredibly leveraged positions. And all you need is the usual thing, you know, a bird flying in Africa and creating a storm in Northern Europe. It's that effect, it's a butterfly effect, yeah? So what it means is that when some of the obscure markets that we don't follow become illiquid and they fall, next price is 30% down. There are leveraged players in all parts of the economic system, all part of the market system, and they get margin calls put on them. And initially they may be able to borrow to cover the margin calls, but if this goes on for a bit longer, eventually their borrowing capacity is eroded and they physically have to unwind their position or put more margin calls. And that is exactly the phase we went through. We went through a phase where, because the bad assets had no liquidity, good assets had to be sold. So there was a week when the treasury prices went down, when the gold went down, everything that was defensive and safe was marked down because the leveraged players had to sell something to stop getting foreclosed on everything they had. So you go through those cycles and eventually you go to second stage and third stage, and we'll get to a stage where fundamentals become more effective and people will look at the balance sheets and the revenue account and say, this is a good company and this is a bad company. And that's how the sort out will occur in the coming 2-3 quarters.
Okay.
Thank you very much,
AshokBhai.
AshokBhai. That was very clear. Thank you.
Okay. Just one very direct question comes from Kalpesh. I will read it out on behalf of Kalpesh. What is the impact on mortgage? I am looking to remortgage my house. Any advice on what type of deal I should go for? A basic and a very direct question.
So, I mean, you know, I started by saying that unlimited quantitative easing is another format for yield curve control. And what yield curve control does, because of the dimension of this crisis, the magnitude of the crisis, the scale of the crisis, the length of the crisis that we're going to be in, it means that, you know, even the 5 and the 10-year yields are likely to be very close to 0%. So we are going to remain in a very low interest rate environment for an extended period of time, The ability to raise interest rate is going to be incredibly restrained, and it's not going to be done for an awful long time to come. And from that, you can make your own decision, whether you want 1 year, 2 year, 5 year, 10-year mortgage. And that depends on so many of your personal circumstances, job security, your other equity, your total wealth, It goes on forever, yeah?
Okay, makes sense. I think that will benefit a lot of them. Good question, Kalpesh. There's a question from Parash Shah. I'm going to read it out to you. It's quite clear. So you sound fundamentally bearish on asset valuation. What is a signal for you to start investing on high yield, non-investment grade bonds?
I'll answer the second. There are 2 questions. I'll answer the second one first and then come to the first one later.
Mm-hmm.
So, I mean, effectively, the high yield is really a no-go area because simply the balances are going to get eroded quite dramatically. And as I was saying, we need to wait for the second quarter result really to understand how badly the company's revenues have been damaged, and then ultimately the ability to make coupon payments will become transparent. So when you get a recession, you get what is called a credit downgrade cycle. When you get a credit downgrade cycle, fundamentally, you do not buy something that is going bad on you. You won't go into a shop and buy a pear when you see it's going to go bad. You're going to have to bin it, won't you? Or an apple. It's very similar. You buy a high yield, which is going to go bad. It means the price is going to drop. So it's no point in buying it. You have to be patient for, first of all the bad news to be on the table. Then you need to be patient for all the credit dynamics, the credit rating agents to come in and actually do their job and say this thing is, you know, credit rated, whatever it is, because its EBITDA cover, its interest cover is been eroded, it's like this. And then you need to wait to see how, if the balance sheet needs to be repaired, how will it be repaired? And it's at that stage that you come in and say, right, okay, I have visibility on how this balance sheet is going to evolve. And I'm happy to take that kind of a risk. So that's the first one. Your first really was that I'm fundamentally bearish. I would not call it bearish or bullish. What I'm trying to tell you is that if the central bankers are injecting huge amounts of liquidity, we are in a world where the prices are controlled by the central bank. The prices are not controlled by the market, simply because they have the firepower to be the clearing, last clearing price is done by the central bank. So if the central bank is calling the pricing of the asset markets, and it is with unlimited quantitative easing, then you are in this world where prices are fixed. If prices are fixed, and they're not going to change until they decide to change the way they function, then you live in a world which is full of illusion. That illusion may be with us for some considerable period of time. So the question you have to ask is, if I own an asset A, what is the rate of return I can get if my holding period is 5 year, 10 year, whatever it is? So ultimately it's driven by the underlying company's earning power, and you discount it at a realistic risk rate. So if you buy an expensive asset, your forward rate of return is going to be that much poor. You buy a good quality asset at a cheaper price, then your forward rate of return is much better. But we are still in a period of high, extreme uncertainty. We are in the middle of a meltdown, economically speaking. So, if you don't have visibility, you're buying like a gambler. You're just betting on 230 horse in Campton, whatever. Why? That is not called investing. That's called speculating. So let's be clear. If you're investing and you cannot see the visibility in order to understand it, then you should stay on one side until visibility appears. So it's not a question of saying I'm bearish or optimistic or pessimistic. We want to be able to carry out the due diligence in order to ensure we understand what we are buying. If you don't understand something, do not buy it.
Very true. I have few more questions, AshokBhai.
Fire away.
Fire away. Okay. Just let me get to one of them. So one question comes from Mayuri. Mayuri, yes. Do we have a clarity on the unemployment in UK? What would be the impact in UK job markets, particularly in BFSI?
So, the way I would put it is that, the government has a support scheme for 3 months on furloughed employees up to £2,500 a month, etc., etc. And it's time to expand that to different segments of the population that it has missed out first time round and so forth. But these support schemes are incredibly expensive. If you look at the numbers involved, and when they become part of the budget deficit, they're going to be huge, which is what I'm saying. The budget deficit for this year, for most of the developed countries, is going to be around 20%, which are huge numbers. Talking about very large numbers. So I think that what you will find is that some of the support schemes will not be rolled over because they're just too expensive. They will try to partially open the economy. It is a complicated equation. The government does not want to be blamed for accelerating the rise in unemployment. It's doing exactly the opposite for now. But a lot of companies are, despite being following employees, are still laying them off. So the unemployment level will rise, and will rise quite dramatically for a period of time, simply because a lot of companies are going to be going bankrupt or go out of business. And that is what creates unemployment. So if you, just to understand, and it's the same for all developed countries, and if you think about the US, because it is easy to get data, about 55% of the people who are employed are by SMEs. So this is companies having less than 1,000 employees. So 55, 60%, about 57% of the US employed population is by SMEs. So that's huge. If you have a large percentage of them going bankrupt, say a quarter of those SMEs go bankrupt, then the unemployment rate is going to rise dramatically. Uh, if you look through the short-term schemes that the government roll out to ensure that the unemployed people do not starve, if you look through that, the unemployment levels are going to be pretty horrific. So in case of the US, people are talking about unemployment rate being 30% plus minus 5%. 30% plus minus, these are huge numbers because there'll be a lot of people who are employed part-time when they were initially employed full-time. How do you count them? So when you do the proper numbers and sum through, which will be done in 3-6 months' time when we have all the data. So something very similar will be happening in UK, where unemployment rate will indeed go up quite a long way. I hope that kind of gives you something that you're looking for.
Yes, I think so. There's another question, AshokBhai. Rajiv Shah, are you there? Do you want to ask your question? Rajiv Bhai?
Hello, can you hear me?
Yes, we can hear you. Please go ahead.
Okay, okay. Ashok, કેમ છે?
Right. You well?
Good, not bad. Okay, so what will happen in the EU? Will the ECB buy the sovereign bonds of Club Med? That is one question.
Yeah.
And secondly, what was the rationale for telling insurance companies to stop paying dividends?
Okay. So let me answer the second question first, and then come to the Club Med because it's an interesting one. Now, in terms of what happened was that in 2008 and 9, when we came out of the crisis, all kinds of companies, including AIG in the US, had to be bailed out. And the reason AIG was bailed out was because they did not at that stage want to bail out Goldman Sachs. And Goldman Sachs had a lot of stuff that the AIG had gone bankrupt, would have bankrupted Goldman Sachs because a lot of its derivative contracts were underwritten by AIG. So in the aftermath of the crisis, the Bank of International Settlement, BIS, in conjunction with all the main central bankers, they sat down for a very long time, like 2 years, to decide what the hell are we going to do going forward. So they came out with what is called a G-SIFIs, globally systemically important financial institutions. And they are too big to fail because they destabilize the world economy. And the globally systemically financial institutions are really big banks and big insurance companies. That's what it's made up of, because they are critical to the functioning of the global economic system. And so once they are tied up into that, and then the evolution of the regulation was that the Basel I became Basel II, became Basel III, became Basel IV, which runs through to 2026, which basically continues to strengthen the bank balance sheet and forces them to continue to deleverage their balance sheet. So that process is not yet finished, it's still ongoing. Simultaneously, what the insurance sector went through was Solvency I and Solvency II, which was a parallel run on the banking regulation, effectively to ensure that the insurance companies were strong enough to digest the volatility of a deep recession, and they do normal tests of minus 30% on equities and property being down 25%, this, that, minus 3% on GDP. So effectively what the ruling that was coming out was that the financial institutions should conserve their capital in order to ride the storm so that they do not need to be bailed out by the taxpayer. So that is really the underlying motive. So the ruling came out, and obviously each regulator is responsible. The Bank of International Settlement does not impose regulations on individual banks in individual countries. That is the responsibility of the individual central bankers to do. But the central bankers have to listen to BIS. That is what BIS is there for. And so the ruling was that initially they said that the large banks should not pay any bonuses and should stop share buyback and should stop dividends. And then they said, okay, the insurance companies, we want to do something similar, but we leave it to the insurance company to decide, as opposed to the central bank or the PRA, Prudential Regulatory Authority, deciding for them. So they were actually given the option. So some insurance companies said, okay, We done the test and we're going to stop the dividend. And some said we done the test, we are strong enough to continue to pay the dividend. So that's the answer to your second question. On the first one, which is the more interesting one, the funding of the Club Med. I mean, the important thing to remember is that within a year and a half, the Italian debt to GDP will go to 150% for sure. If you look at the first quarter GDP numbers for Spain, they are -10 already. So the Spanish government is saying that this year as a whole, they're going to probably have a contraction of 10% as well. So that means that the budget deficit in Spain is also going to be around 20%, and their debt to GDP probably by end of next year is going to be around 140%. So these are very, very high numbers. And if they were not in the union, then the cost of borrowing would be much higher. And so effectively, the whole thing about this is that for now, the ECB will find a way to ensure that it can continue to buy the Italian and the Spanish government paper so that it does not rely on the market to fund those governments, because the market will demand slightly higher price. And since central banker is printing unlimited money, it will just engage in different forms, and it's got a lot of mnemonics on type of programs it is running. But effectively, it's going to find ways to buy the paper issued by the Spanish and the Italian government. So I don't think that there is any problem of the EU blowing up for the euro to blow up here and now. But this will just exacerbate, because until there is mutual sharing of the budget risk in the European Union, so there's a common budget policy, which is not going to happen for a while, then euro will go through its crisis, eurozone will continue to go through its crisis. Just to understand the evolution of the euro, we often forget that it took almost, I think it was about 150 years for the US dollar to be accepted by each of the states in the US. So it took more than a century plus for the dollar to become a common currency for United States. So in that sense, euro is still in its infancy and is still trying to find its feet. And until you have an integrated fiscal policy in Europe, you haven't really got a proper union. You only got a political union, but the other unions are still outstanding in terms of risk sharing of the underlying central bank balance sheet.
AshokBhai?
Yeah, good. Let's see what happens.
Okay, I'll go for another question. There's a question from Mr. Gupta. Mr. Gupta, are you there?
Yeah.
You want to?
Yeah, my name is Udit.
Go ahead.
So Ashokji, very insightful. Thanks for all the knowledge. I have two fundamental questions. So one is sort of amid all the negative situation, right? Which are some of the areas where you see silver lining, which either will see sort of much faster recovery compared to others. And I think question two is specifically on the private equity market, given there is so much dry powder sitting around, and there are sort of so many distressed assets which are going to be created in the next 6 months. So do you see there will be sort of a lot of investment in that asset class?
Okay. There's two questions. I mean, I think in terms of silver lining, there are just not many sectors or companies that are really beneficiaries of what has happened in terms of coronavirus and remember, the real antivirus is probably a year away. But there are some sectors, because we'll obviously be in a world of remote working. The way we live our lives is going to change. There'll be less commuting because people are realizing, it's easier to work from home, and more emphasis on personal hygiene. We are probably going to go faster towards cashless societies and so on. So all the changes will just accelerate in terms of what is happening here and now. Remote education will probably take off in a very big way. So there are a lot of subsectors where the growth rates are going to be pretty huge, and companies that are there and new companies that will be formed obviously are going to have a very good rate of return in everything that they do. But then obviously on the other flip side, I think that it's going to be some time before the economies are rehabilitated. There are all kinds of estimates about how long will it be before we recover the damage that is that is being inflicted by these recessions. And the recovery back to water could be 3-4 years away before we go back to where we came from. And again, in a very high uncertain world, in a where things are not transparent, where we got huge amounts of defaults in the pipeline, both corporate and individual households, and many frontier countries at sovereign level, are going to go bankrupt. I think when I looked at it about a week and a half ago, 102 countries around the world had asked IMF and the World Bank for some kind of help, to bail them out in some format. So you have a lot of high risk sitting there, which is going to explode in different pockets. So the silver lining is that, one has to continuously do the standard due diligence, which is you got to be happy with the balance sheet. You got to be happy with the revenue. You want low leverage, you want stability of your revenue account, you want free cash flow generation, things like that. That means these companies will survive. And when they come out on the other side, they will be the ones who are consolidators. So they're going to get bigger when they come out with less competition. So the rate of return on capital is going to go up. So the silver lining is identifying, who the real long-term survivors are going to be when we come out of the crisis. Now, in terms of the world of the private equity, it's an interesting question because right now, the real action is taking place in what one of the questioner asked about high yield. So the real action is taking place in getting the firepower ready for distressed fixed income asset purchasing. So it's a lot of new hedge funds launching or raising a lot of capital to deploy into distressed assets. So this is when you raise the money to deploy it in 3, 6, 9, 12 months time. And a lot of private equity, obviously, private equity works in 2 or 3 different formats. There's a lot of private equity in the world of technology and all that. And that will just keep accelerating, finding, long-term winners and so on. And there's a lot of private equity in biotech in that area. And again, they are unhindered. They just have to keep doing what they were doing because there is no disruption in the space. The other one, which is private equity in a lot of other fields, I think that they'll be very reluctant because a lot of the private equity are going to get hurt. And in the US, they have enough clout so that they were able to participate in some of the freebies being given by the $2.2 trillion package. Initially, they were excluded, but then they were able to because they were running a lot of companies which are less than 500 employees who could claim those benefits. So they were then given the dispensation to go and claim it. So the world of private equity, I think you will find, is cut into 2 or 3 segments. One that have been beneficiaries and they don't care about this crisis, and they are net beneficiaries in any case of the crisis. Then you have ones that are going to be in real pain because they are in sectors which are getting decimated and will take a long time to recover. So those losses have to be absorbed. And then there are the other ones which are basically chugging along, nothing dramatic. The point is that none of them can unlock those holdings into the listed market because the listed market ain't going to look at it, those kind of names here and now. The new issuance is going to be pretty flat for some time to come. The fact that, the private equity has a lot of firepower left, maybe when the dust settles, they'll be able to identify cheap, viable assets and come in and then begin to pick them up. That could be a long wait.
Sure, thank you.
Okay. Ashok, I see a very long list of questions, so we'll not go any further. One last question I will read out. I don't have a name here properly. So we see the markets are already down, but as you said earlier, you are expecting further, it's going further down later on when the next results come out. What are good opportunities in the current market scenario? What is your advice?
I think it depends on so many things. It depends on the amount of risk you want to take. It will depend on what other assets you have, what your risk profile is, what your time horizon is, and many, many more things. But generically speaking, the way to think about the equity is probably falls into two very simple ways of looking at it. You are either going to say that this mess is going to be with us for an extended period of time, and the uncertainties are not going to be resolved for some considerable quarters to come, if not 2 or 3 years. In that case, you need to have what I would say is a very defensive package, which is the companies that basically are recession-proof companies. They make things which everybody needs on a day-to-day basis. They're vital for the system to function. They are vital for societies to work. They are vital for households to work. They're vital for the governments to work. So those kind of companies will never disappear from us. They'll be here for a long time. They'll be here long after we're gone. And they are fundamentally very strong balances, low debt, and a lot of cash flow because they are selling things that the system needs. So those would be the defensive if you thought, this is a terrible place, the world is a terrible place. And then if you are optimistic and you say that, oh, wait a minute, human beings are so innovative, they always find solutions to any kind of issues after a period of time. And no doubt we will find antivirus to coronavirus itself, and we will rehabilitate and will come out on the other side. Then you can start thinking about what I would say is the recovery packages. Again, companies that are going to be the big beneficiaries when the growth returns and employment cycles return, when the spending returns, when the capital spending returns and so forth, consumer spending capital and so on. So there are a lot of companies like that that will benefit from the uptick of the real GDP, of the nominal GDP. But then again, that requires you to be willing to take an optimistic view and probably a slightly higher volatility on your portfolio construction. So you just run through filters and you can pull out, which are large, liquid, and household names or names that are very well known by the public.
Okay. Nimish Mehta. Nimish Bhai, are you there? Do you want to go ahead with your question?
Hi, AshokBhai. So my question is that we have no trade deals in sight. We already had fairly large debt. With the increasing spending that the government is about to, to do to support the economy through this, what do you think will happen in the next couple of years to do with inflation, the value of the pound, and our cost of living?
Okay. As I said, I don't think inflation is an issue here and now, probably for 2 years at least, simply because you will find that there is excess of everything that anybody needs, and therefore very little pricing power is available. And inflation only embeds into the system if the demand is a lot higher than the supply, and we are not going to be in that position for some period of time to come. I would not worry too much about inflation here and now. It's a much longer term issue, 3 to 5 years onward, then inflation will begin to sink in. In terms of the sterling, it's always going to be difficult. So if you can do lots of long-term regression and say, what is the long-term fair purchasing power parity and stuff like that. There are different ways of looking at it, and most of them will tell you that the long-term value of sterling is around 145 to 1.5, 1.45 in that region against the dollar. But because we have a lack of visibility and uncertainty on the Brexit process itself and on the eventual trade agreements with large part of the world, that uncertainty is what the market dislikes. Market does not care which route you are following, as long as it says, do you know the route, and show me the route, that's fine. Then the risk content goes down. Since we don't have any trade agreements and we know it's going to take some considerable period of time to have lots of trade agreements set up around the world, then that level of uncertainty is now reflected in the sterling fair value, around 15% or whatever it is. And that will only evaporate or reduce when visibility comes into the path UK has chosen, the route is going to be followed. So it's destined to remain undervalued for a period of time. But don't forget, you can't look at sterling in isolation, because you have to say sterling against what? Against the dollar, euro, yen, what? And I was explaining that the dollar is the world's reserve currency of last resort. It's always a currency benefits from flight to safety. It has the best companies in the US, the best economic setup. It's a decent political system. It's mess. The US is a lot less than mess everywhere else in the world. And you can go on and on and on, and you will find that in almost everything, the US takes better than everybody else, which is why you cannot dislodge the dollar. So, betting against the dollar, if your home currency is dollar, is a bad thing to do.
Okay, Nimish Bhai, that answers your query.
Thank you.
Okay. we can go on all night, I think, if we go with all the questions. So I'm going to stop here. Ashok Bhai, did you had some more slides to go through, or you are okay?
I'm okay. I just left this slide, this one here, which is a global macro snapshot. It compresses an awful lot of information on one slide. You know, I don't want to go through all of it. It's just too much to go through. But it kind of tells you the things that I worry about, and you know what I worry less about, basically. And you know, this kind of, when you look at what's in front of us here, it tells you why one needs to be cautious, period.
Girish, can I speak?
Yes, go on.
So it's a difficult balance, isn't it? We have falling fuel prices, very low interest rates, a lot of money coming into the system. Corporates were sitting on a lot of cash, and yet the jobs are not there. So it's tricky to understand quite what will pan out in the next maybe few months.
I mean, exactly, like, what are you looking for? Are you looking for at the employment level, consumer growth level, retail sales, capital spending, profits, earnings? I mean, what are you looking at?
I'm thinking about people's spending power, because as a smaller business, my clients are hit by their employment status. So I'm looking at a very drastic fall in income for the next 6 months until things settle down.
Yeah, but the consumption spending is not going to return for a few years, not 6 months, because, you know, once you have a very high level of unemployment, the spending power for those unemployed people is going to be eroded until they go back into the employment cycle. So then what you have to say is, you know, when are those people going to be put back into employment? And employment creation only happens when economy is motoring away and there's a need for companies to begin to recruit people. And that is not going to be with us for some considerable period of time. So we have to get used to reduce cash flows for some considerable period of time. You know, we are not going to go back to where we came from for a few years. So you have to, everybody has to downsize, full stop, to survive.
Yeah. Okay.
So talking about the growth, Bharat Bhai Shah from Sigma, I think you have a question. Do you want to go ahead with your question?
Hi, Ashok. How are you?
I'm fine. You're right, bro?
Okay, fine. Yeah, very interesting and really enlightening presentation. My question is, Ashok, which sector is going to show growth in this difficult period?
Okay, so I mean, the sectors that are really going to benefit, you know, we've seen, for example, you know, the people want stuff delivered home, for example. People want to do conferences or work from home. People, you know, want to have more education at home. So it's really, you need to look at the lifestyle changes that are being imposed on us, but they become permanent way of life. You know, and then that creates a lot of opportunity simply because new market opportunities are opening up. And then, of course, I think everybody will want to have better leisure activity time. In other words, we can support people in how they spend their time, because they're now used to saying that, why should I spend 2 hours going to work when I can work from home? And I got 2 extra hours of spare time, you know, and so you, as a system, need to deliver something for those 2 hours. So whether you're a streaming service like Netflix, you know, or whatever. So there's going to be a lot of changes the way the world is going to work. And you know, anybody who can kind of deliver to the new segments that are going to be opening up, I think that's where the growth is going to be. And that's where the profit margins will be. So I don't know. I mean, for example, think of in a very simple way, okay? Even when we start returning to our return to work will be very slow pace and will maintain social distancing. So for example, in Hong Kong right now, You're allowed to go into restaurants, but no more than 4 people can go together at any one point in time. And when you go into the restaurant, every next table has to be empty. So it's already telling you that the leisure activity and dining is one of them. Anybody who can service them in an alternative format, very high quality takeaway food, yeah. Again, new markets will open up simply because we can't return to the lifestyle we had before for a couple of years. Who knows how long that is going to be? And those changes, if you do something for 2 years, becomes a way of life. And then it's very hard to change that way of life.
Thank you very much, Ashok. Thank you.
Thank you, AshokBhai. I think it's almost 30 minutes overrun. AshokBhai, do you want to wind up this presentation, closing line from you, and then we can give it to Manoj ji for the vote of thanks?
Yeah, okay. I wanted to flick through just this last 2 charts very, very quickly. This chart, this is the negative yielding debt. So remember that we still have close to $13 trillion worth of debt instruments which are on negative yield. So if you buy these things and hold them to maturity, you are guaranteed to lose nominal amount of money. And this is an interesting question in terms of, people are talking about what should I buy? This is an idea of people are saying, I don't want to buy anything. I want to be safe and I'm happy to lose some money because I know exactly what I'm going to lose, but I want to retain my rest of my capital. So just think of it very differently to what everybody else will be trying to pump to you, okay? So it's a very dangerous and a risky world is the way I would put it out there. And this is the slide which I was trying to show earlier, that the level of indebtedness in the world just keeps rising. And when initially when you take on debt, it's very good because you can employ your debt very profitably. But the capital efficiency of debt reduces as you get more and more indebted. So that basically to generate 1 unit of growth, you need not 3 units of debt, you need 4 and then 5 and then 6. And so you get diminishing rates of return as the leverage in the system goes up. And in this crisis, this thing is going to go up by another maybe 10, 15, 20%. That means that the rate of return on the debt is just going to be 0, which is why we are stuck in a world of 0 rate, because if you increased interest rates, and if the rate of return on the debt is already very poor, that means that you are then going to create a God almighty default cycle everywhere. And the world will go into a tsunami of downward negative feedback loop. So as long as we have this debt and we are in this catch-22, we can't get rid of it by defaulting or giving forgiveness, then we cannot increase interest rates until the debt levels go down. The debt levels cannot go down unless we have a strong growth, but you can't have strong growth because already too indebted, so the capital efficiency has gone down too much. So there are many ways to read this kind of chart. What it's telling you is that human beings are optimistic, but if you're too optimistic, it makes you make mistakes. Managing wealth is all about preserving capital and making it grow steadily. And if you are a conservative investor, then this chart is also telling you that the world is getting incredibly a dangerous place. So just be very careful. And then I just want to finish off with this kind of very simple slide. It really is really simple. So there are 5 sectors, I would normally look at to kind of, you're driving a car on the motorway and you're saying, how is the road feel like? Should I be accelerating, decelerating? Should I take a break into the next next stop? And what this is trying to tell you is that, if you look at the monetary policy right now, it's green for a while to come simply because you are in a world of 0 interest rates and massive unlimited printing of money. So that's incredibly loose monetary policies, and that's very good for the risk markets, for the global economy, very supportive. And you look at the fiscal policies, again, governments are doing whatever it takes to keep us from starving and keep the economies alive And it's going to be like that for probably another year and a half. So again, huge amount of support, which is then good for the economy and good for the economic growth. And then if you look at valuation, I'm putting in green because it was done 2 weeks ago, 3 weeks ago. Since then, of course, the markets have risen and the earnings are beginning to fall. So maybe in a 3 months time, this might go red in the sense that big down earnings will come in and then the valuations will become very expensive. And on the earnings, I'm saying that the market expectation on earnings continues to be far too optimistic. The market is lining itself up for a lot of disappointments to come in the next few reporting seasons. And then the sentiment is very difficult because you go through a period when it's like suicidal, and then you go through exuberance and suicidal. But really speaking, I think it's going to remain pretty awful simply because people are just going to feel bad, when they look around themselves and how the volatility in the risk market. If markets go 5-10% up or down in a day, it doesn't compute. It's silly. It's just telling you it's the volatility of that kind. It's crazy. The VIX index, I don't know how many of you follow the volatility of S&P 500. We got to 75, and we are now still around 35, falling steadily. And the long-term volatility of the S&P 500 is sub 20, around 18, 19. So we are still in a very, very volatile environment where the sentiments will go from being suicidal to highly aggressive and optimistic. But to me, it feels like it's changing so fast, I just worry about it. So unfortunately, there is no ember. It's either one extreme or the other extreme. And when you put it all together, that is why it's so confusing. That is why, you want to be cautious, but there are things happening. We say the system is being stopped from caving in. The system is being on life support system from the governments and from the central bankers in order to create financial stability. And markets themselves feed into the financial stability. It's a circular relationship. So just think of it like this. When you work out what the current financial conditions are, one of the input into that is the state of the financial markets. So if the financial markets fall, the financial conditions get tighter, they'll fall further because they are like a feedback loop in there, which is why the central bankers do not want the financial markets to fall, because it tightens financial conditions above and beyond what they want it to be, so that the amount of the help they are putting, they are hoping that in a year from now, things will be much better, even though in the short term, there's nothing they can do. There's nothing anybody can do about the rise in unemployment. Simply the rise in unemployment is due to the fact that the companies do not have the cash flow to pay their wages. It's as simple as that. And how do you restore cash flow? You restore cash flow by ensuring that the financial stability leads to economic stability and then economic growth. But this is a long, takes many quarters to work this way through. So, I mean, this tells you why it's so difficult. It's not red and it's not green across the board or on average, yeah? Right in the middle. So I'm going to leave you guys with just this last very simple thing, which is just, you can read it later.
We will be distributing this to everyone. So there's a lot of people asking for it anyway. So just to let them know, we will be distributing that later on and let you know on the groups. Please continue. Sorry to interrupt you, AshokBhai.
So, I mean, my kind of last line there is roughly what, I mean, remember that I am looking at it from a point of viewing as managing one's wealth as opposed to managing assets in terms of, if the market goes up 5%, I want to be 5%, market goes 20%, I fall 20%, I don't mind. That is not how I'm looking at it. I'm saying that, if you spend a whole of your lifetime building your assets, then you want to preserve it for your next generation, and you don't have another lifetime to create more wealth. And that means that, capital preservation and capital stability and the downside risk become paramount. And that basically means that, portfolio construction needs to be fairly conservative and needs to be very stable. And you need to make sure that whatever you're doing does not embed terrorists, which one day mature and wipe out, large amounts of your asset base. So always worry about things that will go wrong. You can't time it 1, 2, 3, 4 years. Nobody can time it. But the less tail risks that are embedded in your portfolio construction, your asset allocation, asset construction, the stronger your portfolios or your asset base will look, and more comfortable you'll be able to sleep at night and not worry about the volatility or the dips in the asset market. You can slip through that and say, no, I am happy because my portfolio construction is resilient, stable, it's long-term, it's non-trading. I don't need to look at it every minute of the day. In fact, if I don't look at it for 3 months, it doesn't matter because I know it's very strong, stable. So that's what I would say, you know, as my parting short comment.
Thank you. Girish, you're on mute.
Oh, sorry, I was on mute. Thank you, AshokBhai. That was a fantastic presentation and good insights. We move on to the last bit of this program. Manojji, are you there?
Yeah.
Please.
If I get a couple of minutes for vote of thanks, AshokBhai, thank you very much for the poignant and sombering music of 90 minutes non-stop. Beautiful. And I also take the opportunity to thank Girish, who has done spectacularly well and managed the show very smoothly, very ably supported by Sulabh Jain and Piyush Jain as well. I also take the opportunity to thank all our patrons and chief patrons who are here today. And I also notice Nemu Bhai Chandriya and Mehul Bhai Sangrajka was earlier here. And it means a lot when, you know, the people who were key in setting up Jito in UK, you know, made massive contribution and they still come and support us despite their busy schedules. So thank you very much for that. I also noticed there were a lot of young participants here, and God knows, you know, what is there in the brain? There are all sort of questions which I can't even think of. So beautiful. And likewise, you have had, you know, a lot of female participants here today, very emboldened with that. I also take the opportunity to let you know that we have collected about 7,000 pounds now towards pandemic relief in India for supporting day-to-day living and groceries for about 700 families in India. And that couldn't have been done without your help. I also make a couple of apologies. Not all questions we could entertain. That means there's appetite for another webinar in near future, which AshokBhai, you know what we are referring to.
And this time we will come with 500 capacity on our platform.
Absolutely. And also, I know there are a few people from abroad, you know, particularly from India in the audience. So thank you for staying awake so late in the night. And what was the last point? Yes, I know it's Chinese or has got Chinese bearing, but let's thank Zoom as well that it has done very well. Stay
Indeed.
safe and good night.
Thank you. Thank you, everyone.
Thank you.
Good night, everyone. Thank you.
AshokBhai,
everyone.
fantastic evening. Thank you very much.
Thank you.
AshokBhai, thank you very much.
Thank you.
Thank you, AshokBhai.
Thank you for all the organizers as well. Thank you very much.
Thank you.
Thank you, Ashok.
Thank you.
Thank you, AshokBhai.
No problem. Enjoyed it.
So there was a time, AshokBhai, when we couldn't take more people in because we had a capacity of 100 on it.
Oh no.
So that's a lesson for us.
I've got
We got a lot of messages.
Yeah.
If somebody's coming out, we want to come in.
Girish, there are many people yet on the call.
That's right. That's everybody knows that. So
yeah,
this is something people noticed that. Some people came in later on because obviously it wasn't feasible in the first round.
No, you should get the version where it's unlimited.
Yes. But fantastic, good time and excellent insights, AshokBhai.
Thank you. I think as long as everybody enjoyed it and it wasn't a waste of time, then it's been a good.
AshokBhai, you can answer a variety of questions, you know, from local unemployment level, paying my mortgage, right through to international monetary markets. And so it makes it for a wide variety of audience. And I think, Girish, it's probably for the first time we've done, maybe 100 is a reasonable, manageable session. 500, yeah, we can move on.
We can
Worked
take
very,
that
very
later on. Yeah.
very, very well. And for the first one, well done, team. Absolutely brilliant. You know, within what, a week or so, you know, after one call to AshokBhai, and then it got off
Yeah.
well set up. Well
I
done.
think
I was nervous at times.
AshokBhai's availability triggered everything, and
Yeah, sure.
that was good for us.
Yeah, thank you,
Okay.
AshokBhai. As ever, I'll ring you tomorrow or on my walk.
AshokBhai, sorry.
I will only do it on a non-working day, so you've not done 5 Zoom calls.
If this was an event in a hall, I would have stopped you and asked you a quick question. But because we are all on Zoom, and I assume you're not planning to go anywhere tonight, can I ask you a quick question? Yeah. Yeah. You see, the way the liquidity is being injected everywhere by central banks, yeah, and governments, do we see kind of another asset price inflation like we had after the financial crisis, where the inflation wasn't there, but the asset prices just zoomed up because there's no cost of capital?
Yeah, so I mean, the way to think about it is if you basically segment the fixed income market separately from the equity market, and you already had a good almighty bull market in the fixed income, because as interest rates go down, the value of existing paper continues to climb up. And as we go to zero interest rate, it will just keep going up. But a large part of the journey has already been